Hello and welcome back to the channel. In the last video, I mentioned a change in strategy where I begin to seek some more exposure to the S&P 500 instead of the broader Canadian exposure, and in this video I continue to adjust some of my holdings around to reflect this change. The new allocations for this portfolio are going to be tilted mostly towards the US market, at about 75% into broad S&P 500 ETFs and technology stocks, and then the remaining 25% will be allocated to the Canadian market and longer-term dividend growth stocks. To adjust my holdings and to start the transition to the new allocations, I decided to move around $11,000 worth of capital within the portfolio. A lot of the holdings I sold out of were from when I was first starting out in investing, and I bought into them for their diversification and for their reputations as consistent dividend payers. They were solid investments at the time because of how much the market had sold off, so there was going to be an eventual bottom and they would be able to provide short-term profits. But now with a bit more experience and the release of so many great ETFs, I feel that these original holdings are no longer the ones that will provide me the growth and speed at which I want to reach my goals with this portfolio. Now with that, let's get started into all the changes I made in the last 2 months. For transparency, to show the $11,000 number I keep mentioning, we go into the transactions tab in the spreadsheet and filter by the months of January and February. We can see all the transactions from only these 2 months. If we highlight the sell value column, we can see the sum of the highlighted cells in the bottom right corner, which shows the total of just over $11,000 in holdings that were sold and reallocated elsewhere, which we will now get into with all the trades I made. I originally added ParcelPal as a penny stock play with hopes that it would show some quick growth, but it's become an eyesore and I just wanted to get rid of it. I tried to sell this for break even, but unfortunately there was not enough trading volume, so I took a small loss of $13.37 on it. Granted, I only had about $27 invested in total. With Power Corporation near its all-time highs, and while it looks to be a solid dividend grower every year, I didn't have much invested in it and I wanted to consolidate it into something that provided more yield and growth potential. At around the same time, Purpose ETFs finally released new funds from Microsoft and NVIDIA to their offerings. I've always wanted to include Microsoft more directly somehow in the portfolio and did consider the CDR version, but it didn't provide any dividend income, so I decided to wait it out. With my positive returns so far in the other Purpose ETF funds, this made it a no-brainer to add to the portfolio as soon as possible. It doesn't provide a high dividend yield with around 5.87%, but it does have the potential for growth in terms of stock price appreciation. By selling Power Corporation, I actualized a $193.88 profit for a total sell value of $1,220.16. And if we include $87.40 in dividends received, then we have a total return of $281.28. With the full amount from the sale, I reinvested it entirely into MSFY as a starter position and was excited to finally have Microsoft in the portfolio. I originally started with TXF when I was looking for some tech exposure, and then HTAE was released soon after, so I started a position in it as well. The two of these ETFs have been nearly identical in performance over the past year, so for consolidation I wanted to narrow it down to just one. The difference between the strategies of these two funds is that TXF writes covered calls on up to 25% of the portfolio, while HTAE writes covered calls on up to 33% of the portfolio. And finally, TXF does not use any leverage, while HTAE uses an additional 25% leverage to enhance the overall performance. What this means is that TXF may see greater stock price appreciation when the market goes up, because it only uses up to 25% of the holdings to generate the dividend income, while the remaining 75% of the portfolio will be held for growth and stock price appreciation. This in turn is also reflected in the lower dividend yield of the ETF. HTAE on the other hand will not see as much stock price appreciation because it rates on up to 33% of the holdings to generate the dividend income, leaving about 66% of the portfolio for growth and stock price appreciation. This is where the extra 25% leverage comes into play and allows for the ETF to provide an enhanced dividend yield and also see greater growth at the same time. But of course, keep in mind the opposite is true. When the market goes down, then the extra leverage will negatively impact your returns. But over time, the market does trend upward, so if you can sit through the more volatile times, you'll also be able to see those greater returns as well. So after all that work, comparing and contrasting the two, I decided to take my profits from TXF and reinvest most of it back into HTAE. I could have continued to hold both, but the higher dividend yield and the benefits of being a monthly payer just outweighed the slightly higher potential growth in TXF. By selling TXF, I actualized $989.85 in profit for a total sell value of $3,536.12, and including dividends, we can add another $348.38 for a total return of $1,338.23. I put the original investment of around $2,600 back into HTAE, and then the profits of about $900 into MSFY to add on top of my starter position. As mentioned earlier, Purpose ETFs released an NVIDIA ETF at the same time as their Microsoft one, and I was thinking of including it as part of the Magnificent 7 in the portfolio. But with how high the price NVIDIA has gone up so far, I didn't want to get burned if it were to come crashing back down. Also, they had earnings coming up as well, so it was a bit of a gamble as to whether or not the price will drop significantly or skyrocket even higher. I decided to put in some small starter positions about 2 weeks before earnings and immediately saw a 10% gain. So after some thought, I decided to not chase the price any further and to just hold what I have already invested, which was around $200 through the earnings, and then sell for any profits to reallocate elsewhere. The earnings happened and the stock actually jumped even higher, so I took the small profit of $35.01 and put it towards Aduro Clean Technologies, and then reinvested the initial investment of $200 into YAMZ. I know I had just bought into BKCL at the end of December in the last video, but when reviewing my portfolio, I already had in mind that I was going to eventually take profits from all my insurance holdings and reallocate them elsewhere when I found the right time or the right reasons. After learning about Bank, it has all the same holdings as BKCL, except it also includes all of the Canadian insurance companies as well. Not to mention, Evolve ETF employs a slightly different strategy where they rate on up to 33% of the portfolio compared to 50% of the portfolio with BKCL. Bank also provides a slightly higher dividend yield of around 16.04% compared to BKCL's 15.5%. So by switching from BKCL to Bank, it will help maintain the existing diversification while providing slightly more growth potential on the stock price appreciation and also a slightly higher dividend yield at the same time, all within a single ETF. I ended up actualizing a $15.61 profit for a sell value of $2,647.40. If we include dividends, then we made an additional $65.17 for a total return of $80.78. This was just a straight swap, so I reinvested all of it back in the bank just before the ex-dividend date, so I was able to bank in that slightly higher dividend yield as well with this change. Like the other insurance holdings, Manulife was sitting at 52-week highs after their earnings, and I decided to take the profits and reallocate it to something with higher yield and more growth potential. Because my USCL allocation was still low and not where I'd like it to be for my US exposure, I decided to add the entire Manulife position to USCL. I did wait for an opportune time to sell and was able to double dip the dividends by holding Manulife until the ex-dividend date and then moving it to USCL for USCL's next dividend date the next day. This means I'll be able to receive dividends from both Manulife and USCL next month. On the sale, I made a profit of $486.86 for a total sell value of $1,628. If we also include the dividends earned, we can add an additional $94.78 for a total return of $581.64. The entire investment was then all put towards growing my position in USCL and also increasing my monthly dividends. Algonquin Power was one of those holdings I initially bought into for its popularity and dividend when I first started the portfolio, so I didn't do much research on it. It has been my worst performing stock up until Tesla's crash last month, and I was holding AQN in hopes for eventual break even or to recover some of my losses by averaging down a bit. I should have sold it when it was about $200 away from break even last year, but decided to hold out for that extra little bit unfortunately, and it dropped back down. In any case, the stock price has continued to drop and doesn't show much sign of life in the near term, so I decided it was time to just cut my losses and quickly use the capital elsewhere for a better chance at recovery. I put a majority of it towards USCL, but also decided to split up a portion of it into the individual tech holdings as well to increase those positions. At the end, I took a $834.07 loss on the sale, and was left with a total sell value of $1,789.92. If we factor in the $159.02 I received in dividends while holding the stock, then the actual loss was only $675.05. So the dividends cushioned the loss by a little bit. I ended up putting about $800 into USCL to again increase my position some more, and then split the rest among the other 5 individual tech stocks I hold. And there you have it, those are all the moves I made in the past 2 months. All those changes have reduced my total holdings in this portfolio from 26 holdings to 22 holdings, while increasing my dividend yield from 8.95% at the end of December to now 10.19%. But also a note here that the stock price fluctuations also impact the dividend yield percentage, so with Tesla tanking recently, it has greatly contributed to this increase as well. What doesn't fluctuate as much is the annual dividends, and since the end of December, it has increased from $6,979.82 to $7,809.88 a year, with majority of it due to the moves I made in this video and reallocating into higher yielding ETFs. That is a significant increase of $830 in annual dividends each year, and that's not including the compounding effect when they get reinvested back into the portfolio every month. Another thing to note by going through this process, I come to realize is that the bar chart for index comparisons, by actualizing these profits, has trimmed the capital return value, so it looks as if the portfolio is severely lagging behind, which isn't exactly the case. This is a reason why the total return value holds much more significance and shows the real performance, because it is a sum of the capital return, the lifetime dividends, and all the profits or losses realized from buying and selling. This is just something to keep in mind when looking at the numbers and how they changed on a month-to-month basis when I do these reviews. As a general observation on investing as a whole, I think it's safe to say based on all the changes I made into these newly released funds, these types of returns were not possible for dividend and passive income investors 2 to 3 years ago. There will probably be many more new funds and products coming out in the future, and it has made it such an exciting time to be a dividend and income investor, and to see the area of investing grow with various new opportunities and strategies. In the next video, I'll be revealing an update on the portfolio performance from January to February, and some more information on the spreadsheet I've built and how I look at it to help inform my portfolio decisions. So if you'd like to see it, please subscribe and like the video to help out with the channel, and with that, I'll see you in the next video.